Thanks for joining us, folks, today for our equity overview webinar. We have a great agenda today to talk a little bit about the value of equity investments in your municipal investment portfolio. With us today, we have some excellent speakers. We have Stephen Goth, Vice President of Client Services at Guardian Capital, and Brian Holland, Senior Vice President of Client Services, also from Guardian Capital. Stephen and Brian represent Guardian, who are the equity portfolio managers for the One Investment Program Legalist Canadian Equity Fund, as well as the Prudent Investing Canadian Equity Fund. From the One Investment side, we have our Chief Investment Officer, Keith Taylor, who will help moderate the Q&A portion of this and make sure that we're giving Stephen and Brian a hard time today. So I'd like to thank everyone for taking the time to join us. And just to, at the outset, I also wanted to offer some thanks for some long-term commitment to the One Equity portfolio. I'd like to thank Brian Holland for years and years and years of dedicated support to the portfolio and helping us explain the equity value proposition to Ontario municipalities. Brian has been supporting the One Equity portfolio pretty much since day one in 2007, 2008. And we've come a long way with the portfolio and helping municipalities appreciate how low risk approach to equity investing can fit the municipal investment need. So Brian, as you wind your way slowly into a retirement and Stephen picks up the reins, we wanted to thank you very much for your dedication and focus to the municipal investment space with One Investment.
Well, thank you, Jason. It's been a pleasure and lots of fun helping municipalities grow their assets. And you're in very good hands with Stephen.
Excellent. Thanks, Brian. So before I pass things over to Stephen, I just wanted to say that, many municipal folks on the line are completing or undertaking or have just completed their planning and budgeting process for next year. And as part of that, many of you are looking at your capital plans and just thinking about 5-10 years down the road that the need you have for capital to do some of the work you want to do and wondering how you're going to get there. So with that in mind, we felt this was a telling opportunity to talk about low risk equity investments as they're available through the One Investment Program, and for the right type of funds and the right type of investment horizon, they can be a great fit for your municipality. So, what we're going to do here is talk a little bit about what is the One Equity portfolio and what's the opportunity, and then Keith Taylor at the end will help guide some Q&A about dispelling some of the fears and myths and whatnot related to equity investment, and talking about how it can work potentially for your municipality. So with that, I'll pass things over to Stephen Goth. Thank you very much.
Thank you very much, Jason, and good morning, everyone, and thank you for joining us. My colleague, Brian Holland, will do most of the heavy lifting when it comes to discussing the One portfolio, but I thought perhaps I would set the table in terms of what is volatility and what we're seeing in the markets and also in the economy. So really, what is volatility? Well, we use it really as a proxy for risk. And typically, the higher the volatility, then generally the higher the probability that an investor will lose money. And so to illustrate that point, I have this exhibit here. Hopefully everyone can see it. What I have is the rolling standard deviation on a 3-year basis for the TSX, which is the blue line. And that is the benchmark for the One portfolio. And also, just for illustrative purposes, I've done the same thing for the MSCI World Index, which is the benchmark typically for global equities. There's a couple of observations that I want to show you here about this volatility exhibit. The first observation is when you look at the blue line, you can see that that volatility is not consistent. Rather, it ebbs and flows. It ebbs and flows. So looking at the beginning of the millennium, you can see that volatility was heightened and began to reduce. And part of that volatility was driven by, you may recall, the dot-com bubble. And at first, the markets got very volatile. And then as we move through the early part of the millennium, it generally starts to stabilize. And then again, it spikes again in 2008 and then remains elevated for a period of time. It comes back down, it behaves itself, And then as we can see in 2020, volatility again spikes. Now, those spikes in volatility coincide with some pretty dramatic events that we saw in global markets. You may recall the global financial crisis in 2008 actually saw the TSX come down by about 33%, and the MSCI index was down about 26% in 2008. In 2020, again, that spike in volatility during the onset of COVID. And again, markets reacted very violently. The TSX was down 21% in the first quarter alone of 2020, and the global index was down about 13%. So the second observation that I like to highlight is that blue line, the volatility for the TSX, is generally about 75% of the time above that of the global index. So the idea here really is if you can reduce that volatility, then hopefully you can offer a degree of downside protection when markets go down significantly. And Brian will talk a little bit about the downside protection that the one portfolio has as a result of some of its systematic allocations to cyclical sectors. I thought this was kind of an interesting graph, actually. This shows the volatility of returns over the past 5 years for the TSX. And as you can see, volatility remains over the last 5 years, 60 months. We've had 22 months in which the TSX has actually generated a negative return. But what's also interesting is if you take a look really from January 2022 and onwards, that's when inflation started to become a concern. And the Bank of Canada began to raise rates in March of 2022. The TSX, since that time, 22 months, has actually been down 12 of those 22 months and has returned a flat return basically of 0.3% and ending in October. So it's been very flat, but 55% of the time it's generating negative returns. What's also interesting is actually it's worse for the fixed income market. The FTSE bond index, which is the benchmark for Canadian universe bonds, has actually been down 15 of the past 22 months. So that's 70% of the time it's been generating a negative return. And since the beginning of January 2020, it's actually down about 12%, ending in October. So volatility remains and still is a concern for investors. So what's generating a lot of this uncertainty and this volatility? Well, war is one of them. Russia's invasion of the Ukraine sent shockwaves through the commodity markets. In particular, oil prices started to spike. Russia is one of the largest producers of oil in the world, and the West moved very swiftly to engage in sanctions to limit that supply of oil. And as a result, oil got up to about $127 a barrel in the spring of 2022. And you may recall at the pumps in the GTA, we were paying about $2.20 for a liter of gas. Now, when commodities such as oil see significant price increases, that fuels inflation, right? Typically, when oil goes up, many other things become more expensive as well because oil is often an input into goods, but also, transportation costs also get escalated as well. So as inflation has gone up, partly because of wars, but also driven by the pent-up demand coming out of COVID as well, saw that people had saved during that period of time and now were spending money. And then, of course, increased demand for products when there was limited supply because of bottleneck issues with supply chains. We saw inflation start to escalate. Now, when that happens, central banks around the world get nervous and they try to tame inflation. And they do that largely by raising interest rates, cutting the money supply and making it more costly for investors and consumers to consume goods and invest. And of course, we all see that within our own Canadian housing market. Interest rates have gone up fairly significantly relative to the low rates where they were before. And that has put stress on consumers as we spend more and more on our shelter, more and more on mortgages, more and more on rents. And that means we have less disposable income as a result of that. And volatility essentially captures a lot of that uncertainty that we're seeing in the economy. But it also impacts the bond market, the fixed income market. And some of you may be familiar with this exhibit, some of you may not. So please bear with me for a moment. I'll just provide you a brief description of it and, of course, its significance. So if I can draw your attention to the gold thin line, what that is the yield curve for the Canadian government bond universe in Canada before COVID. And what it is, it's a fairly normal looking curve, normal in the sense that it is upward sloping. As you can see, the yield, which is on the y-axis, and the maturity, which is on the x-axis, corresponds to what you expect to get paid for the duration or the term of the debt that you are providing to the government. So at the lower end of the curve, the short end, you can see the yields are lower. And as you increase the maturity, or you increase the length of time that you lend to the government, you can see that yields go up. And that's to be expected, right? The longer you're lending money, whether it's to the government or to an individual or to a business, the longer that you lend that money, the longer it takes for you to get your money back. And as a result of that, more things can go wrong. So typically you demand a higher return as a result of that. You fast forward to today, and the green line represents the yield curve in mid-November. And there's two things I really wanted to highlight here. First is that you can see yields have all shifted up, right? As a result of the Bank of Canada's intervention and increasing interest rates. So interest rates along the entire spectrum of maturity have gone up. What's also interesting is that the green line is actually the mirror image of the gold line. And so that yield curve is what we refer to as an inverted yield curve, and that is not normal when it's inverted. When it's inverted, it means that yields at the short end of the curve are higher than yields at the long end of the curve. And the power of this particular exhibit and this particular graph is that when we see this, it's generally a very good predictor of a recession that's in the offering. In fact, it has successfully predicted 8 of the last 9 recessions that we've experienced in North America. So what's driving this? Of course, as I mentioned before, inflation. Right? Bank of Canada responds to inflation, and inflation became a concern at the beginning of 2020. And as you can see here on this exhibit, it starts to escalate pretty dramatically until it reaches a peak of about 8% in June 2020. Now, with the aggressive action of central banks around the world, including the Bank of Canada, we've started to see that inflation come down. Still hasn't quite hit its target, but it is declining. The question becomes, how sticky will this inflation remain? Will we get to a 2% target? That uncertainty remains, and so the Bank of Canada maintains that they will keep rates higher for longer until the inflation bug is slayed. But this all comes at a cost with increased in interest rates. And the immediate cost really is a slowing down of the Canadian economy. And as you can see from this exhibit here, it dropped dramatically around COVID, but then we recovered, and we recovered quite sharply. And we saw some significant economic growth coming out of the pandemic. But that growth has started to slow, and in fact is almost approaching zero. Q2 of this year actually saw the economy flat, and numbers just released this morning indicate that the economy contracted. So some would say that we may actually be in a technical recession, which is often described as you have 2 consecutive quarters in which there is negative growth. So we may actually be there. Contrast that with the United States. The United States remains somewhat robust. Part of the reason is companies and individuals are not as highly leveraged in the US as they are in Canada, and therefore have more disposable income. And the US consumer still has about $1 trillion of savings to spend. So they seem to be chugging along. Quite a different story from what we're experiencing in Canada.
Stephen did a very good job of explaining the situation we're in today. And you might ask yourself, well, with all this volatility and ups and downs, why bother? Why not just put your money into the bank or buy a GIC or something like that? Well, one of the things we know from investing in equities versus investments like GICs and others, other fixed income investments, is that you do much better over the longer term. The difficulty is that in the shorter term, you have to suffer the waves of the market where you can be hit from the valuations of your securities can fall based on what's happening in the world, and has nothing to do necessarily with your investments or what's happening in your portfolio. But a war starts in Ukraine, and suddenly your portfolio value gets hurt. But if you can live through those things, there's lots and lots and lots of data that shows that you're much better off in terms of just creating wealth. And we have some stats that we'll show you on that in a few minutes. So then the question is, okay, well, if I'm going to have to, if equities is the place to generate some value, how am I going to manage this risk? And I'm showing here on this page, and I'm going to go through these 3 basic things that you can do. The first one is something I think we've all learned, probably from our parents, is diversification. Don't put all your eggs in one basket. So diversify your portfolio by doing different things. And the idea behind diversification is that you don't want diversification for diversification's sake. The idea essentially is that you want individual securities or asset classes that will perform on it in its own right, but will behave differently than other asset classes. So we try to do that within the portfolio. The next thing that you can do to control the risk in the portfolio is the kind of investments, quality investments. So you can well imagine there's a big difference between investing in the Royal Bank of Canada versus some junior mining company, gold mining company in the Yukon. There's a world of difference in terms of how they'll behave and the expected return. So if you focus on quality investments, you can ratchet up the quality, but you decrease the risk in the portfolio. And the data actually supports the idea that you'll do much better over the longer term. And then the final bit that I wanted to talk about is strategically position the portfolio. And what do I mean by that? There's been a lot of work in terms of understanding the markets and how they behave. And this is something as institutional investors we pay very close attention to. And think of it as a high probability approach. So when we manage your portfolio, we look at individual securities to try to determine which ones are good quality and will grow over time, pay dividends, and that sort of thing. But the other thing we do is we look at things that have worked over time, some basic overview data that will guide us in terms of how to structure the portfolio to give us a better chance of success. So I'm going to talk a little bit about that in a second as well. So diversification, this is the portfolio at the end of October. You can see at the bottom we have, and I'll show you these names in a few minutes. We hold 35 individual companies. Now, the first thing I wanted to say is that when you listen to the news about what's going on in the stock market, you know, the stocks go up and down, the Dow Jones this and the TSX that, and it becomes sort of abstract. But you need to sort of change your mindset and stop thinking about stocks in a portfolio are something that go up and down and are on the news every night. But think of them as companies. Companies themselves, the stock itself might trade up and down every individual day, but the companies themselves, they don't change that quickly. They grow gradually over time, but they don't change as dramatically as the stock market might suggest that they do. So you need to change your mindset and think about companies. So we have 35 individual high quality organizations that we invest in. And then you can see here the different sectors. There's 11 sectors in the TSX. And you can see that we have more or less depending on the sector, but we're diversified across the index. So in 11 different areas. So each one of these groups will behave differently. And so we want to, this is what I was saying before about diversification. You want things that will perform in their own right, but will behave differently. So if the market goes up or down, you're going to have some diversification that will protect you, particularly on the downside. So the portfolio is very much well diversified. So the next thing is the quality investments. So you say, okay, well, I'm going to be well diversified. I have 35 stocks in different different sectors, categories, if you will. The next step is to say, well, all right, let's look at the nature of the individual company. So what do I mean by quality? And you can imagine that anybody that invests thinks that their holdings are quality, but we mean something very specific. So this circular diagram that I'm going to go through very quickly will give you a sense of it. So the first part on the left-hand side here is there a growth opportunity? So we look at the companies, we look at the industry that they're in, and we say, okay, they have grown in the past. What does it look like, the runway? What does it look like down the road? Can this company, this industry continue to grow? And if the answer is yes, then it's like, okay, well, let's spend some time researching to make sure that we understand the companies and potentially invest. Then we look at the profitability. So, okay, that's fine that it's growing, but are they making money? So we look at a number of things in terms of the nature of the profitability. So the first bullet point here is sustainable competitive advantage. So how hard would it be to unseat this company? So think of a Canadian bank, for example. Suppose you're a billionaire from Silicon Valley or whatever, and you decide you're going to come back to Canada and you're going to start your own bank. I mean, you hear a lot of this bravado, the Elon Musk kind of thing where they do all these things like owning a car company and so forth. Imagine coming back to Canada if you were very wealthy and saying, I want to create a bank. Well, good luck, because if you look at the Canadian banks, they've got branches everywhere. The clients, they've had many of them for their entire lives. It would be very, very, very difficult to unseat and compete with a company like that. So that's the kind of company they're working for, is that they've got this moat, this sustainable competitive advantage that makes it difficult for somebody to come into the marketplace and to put them out of business. So that's the next one of the things we look at. Then we look at the risk. So what is the nature of the business? Are they investing in Canada, invest in North America, or do they have most of their assets in in the third world, for example? You might have seen there was a mining company in Canada, not just in the papers in the last couple of days, where in Panama, there was a mining operation, and they basically just shut them down, and there's questions about whether they'll take over those assets. That doesn't happen in more developed countries where there's the rule of law. So you have to think about where you're investing. You also want to think about the financial strength of the companies, their balance sheet. Do they owe a lot of money? What is the cash flow? What is the regulatory environment? Are they being sued? So there's a lot of these risk measures that we spend a lot of time trying to understand. And good quality companies generally don't have those kind of risk factors. There's always warts on any individual company, but you're trying to minimize those. And that's one of the next criteria in terms of looking for quality. And then finally is the stewardship. We're always looking at how is this company being managed. So what is the board of directors like? Has there been any scandals? Guardian is a signatory of the United Nations Principles of Responsible Investing, the UNPRI. You might have heard that. So it's the obligation of Guardian to make sure that the investments that we hold, we can stand by them, that they're good corporate citizens in terms of the environment, the E. S in terms of it's social, in terms of how they treat their neighbors. Are they dumping things into the local ponds and so forth? What are they treating their employees like? And then governance. Is there proper oversight structure in the board of directors and so forth? And then finally, and the last step is the valuation. What do we pay for these things? We're going to be holding companies for often 10, hopefully 10, 15, maybe 20 years, depending on the company. We do make changes, but if we can buy a stock at a reasonable price, not necessarily cheap, but a reasonable price, then that goes a long way to controlling our risk, because if there's some volatility, there's a better chance that if the market goes down a little bit, we might be reducing our profits on that company, but not necessarily experiencing a loss. So I wanted to give you some sample holdings. I'm going to show you the overall portfolio in a second, but I showed a couple of schematics here of some companies that you may be familiar with and others that you may not. On the upper left hand is the Royal Bank. Again, I use that as an example of a bank. Imagine trying to replace the Royal Bank, competing with them. Boy, oh boy, you'd have a hard time. Then you look at the railway there. Canadian Pacific is one of the holdings we have in the portfolio. Again, think of the difficulty you would have trying to, if you were to try to create a railway from scratch today. No one wants it doesn't matter if you're the city of Toronto or a First Nation, no one wants a railway going through their property. So the people who have those railways in place, boy, that's a terrific advantage that you can use over and over and can't be duplicated. I won't go through all of these, but you can see Metro grocery stores, Stantec. You may not be familiar with that. That's an engineering company. TMX, that's the stock exchange itself. That's where people come together to transact. And you might be surprised, for example, with the TMX, you may think, oh, is that very profitable? I mean, you get commission, maybe get a portion of commissions that are being sold. No, they make most of their money on data. Firms like Guardian and others that when we look at and analyze the markets, we need data, and they have it and they sell it, and it's a very, very profitable business. So it would be very difficult for a company to come in and compete with that. The final element I mentioned in terms of controlling risk is how you structure the portfolio. And I mentioned this at the beginning as sort of like a high probability approach. Where are the danger areas? Yes, we're going to look at individual stocks and how they're likely to perform. Are they good quality and so forth? But what are some of the red flags that we need to look at? So what I've done here, we did a more than 20-year study in terms of the individual sectors in the marketplace and how they've performed. These are the compounded annualized returns. So when you look at the green box on the right-hand side, you'll see industrials, consumer discretionary, all the way over to real estate on the far right-hand side. And you'll see, 11%, 10%. So these are reasonably strong performing areas. And then you look at the left-hand side, where I've circled energy and materials. And then in the middle, you see healthcare, and you think, oh my goodness, over that 20-year period, healthcare has actually lost money. Information technology, with all of the bravado about you can make money on information technology, it's actually less than some of these other sectors. You would have been much better. You look at consumer staples and very boring companies, you would actually have made more money in that than you would have on average than you would have in tech stocks. But it's energy and materials that has captured our interest, because I'll show you some stats in a second, but these are one of the two of the larger sectors in the Canadian marketplace, and ones where we really need to control the risk. This slide here is the standard deviation. So recall earlier in the presentation when Stephen was showing the volatility, and he was using the standard deviation as a measure of that volatility. So the higher the number, the greater risk we think that the individual sector and holdings have within that group. So look at what's happened here. You've got energy and materials. They are a pretty large group. They're amongst the lowest returning sectors of the 11 in the marketplace. And then you look at the standard deviation, you can see energy is 21.05, and then materials, so that'd be mining companies and the like, 25.08. And just scan your eyes across. You'll see, of course, healthcare and information technology being very high, but go across to the other in the green area, a lot lower. So when you look at this, you don't need to be a rocket scientist. You say, well, it has the lowest energy materials, the lowest returns, with the exception of healthcare, lowest returns and very high levels of risk. So maybe that should be the area, an area that we should avoid. So what I've done in this slide here is to show you the average weights, and then the rows below that, highest and lowest weights of those sectors over this 20-year study period. And so look at this, energy materials together. Well, you can see that on average, energy is 21.9% of the market, and on materials, 15%. And then you compare that to all the others. I mean, with the exception of financials, these two are the largest sectors. So it's the larger seconds, so the second and third, on average, largest sectors in the marketplace. They have one of the highest levels of risk and one of the lowest levels of return. And again, you don't need to think too hard about it. Well, maybe we should reduce that. Now, it doesn't mean that everything in energy materials should be avoided, but it means that you should maybe underweight that area. And it also means you should be very, very careful about what you invest in when you go into those sectors. Similarly with healthcare, the healthcare numbers are so low because of it's been hurt by the marijuana stocks. That's where that marijuana stocks, and that pushed that down. And there was other individual names like BioVail and Valiant and which is now Bosch Health, that have been very, very volatile. And you can think of the volatility that we've experienced in the information technology. Remember the old BlackBerry, which was research in motion? Years ago, that peaked out at $135 a share, and now it's I looked at it just the other day, and it's down to $3 and change. So you've lost a lot of money. So it just goes to show you that there are individual names within these sectors that can hurt you quite badly. So we tend to focus on the green area where you can make good returns. You don't have the same level of risk. So how do we structure it? So what we're doing here on the left-hand side, you can see the individual sectors, the energy, materials, industrials, and so forth. And then we've got, now this is a little bit dated. I think it's the end of September, this data. So you can see here in the third column from the left, those are the combined weights of those sectors in Canada. So you can see energy, materials at the end of September, about 25%. And you compare that to the global markets. We're using the MSCI World Index for that. And you can see about 7%. So think of this situation. Because we have such a high resource area in Canada, you could be, for example, if you, let's say you had 20% in energy and materials combined, you might think, well, relative to the benchmark in Canada, you're underweight because maybe you're negative on it. But somebody living in Buffalo, just across the border, who uses a different benchmark, maybe the World Index, they look at it and say, well, the combined weight in our benchmark is 7%, and you've got 20. You must be very, very positive on those sectors. So what we've said is let's step off this madness of what's going on in the Canadian marketplace. Let's look at managing these weights relative to what's going on in the world markets. Let's take a view of, in terms of whether we like these sectors or not, based on what's happening in a more developed market. And we think the world market is probably as good as any. So we use that as a guide to help us construct the portfolio. So the portfolio is systematically underweight energy and materials. And the objective there was, the initial objective was to lower our risk in the portfolio, to give a smoother ride. And you combine that with good diversification and good quality companies, it will provide you good longer term results. And here's a schematic of the portfolio, the one portfolio going back over time versus the index. So in the beige line, it shows the portfolio, and the dotted line, the dotted blue line, shows the index, the TSX energy materials weights. And you can look back into the 2008, 2009 period, 2011. Energy materials combined were about half of the Canadian marketplace. You think, well, okay, I might like some of the oil companies, but do you really want to put half of your money in those sectors that have proven to be more volatile and more risky, and have not delivered the returns? So what we've said is, we're not going to eliminate, but because we see a need for it, we see it, we can see some returns if you're selective, but we're not going to have anywhere near what the index have. So we, depending on the period, we're somewhere between a half and a third of the weight of the index, and that's been pretty consistent over time. So how does this shake out? And when you look at the overall results, and what we've done is we've taken the returns from the one portfolio and we've compared it to others in the Canadian marketplace. And for this, there's a survey company for institutional management in Canada. It's called eVestment, and they compare the returns from the one portfolio and they compare it to everything that's out there in the marketplace on an institutional basis. So this is not mutual funds. This is what institutional investors might do. And so you'll see here, there's four boxes, four grayish rectangles, and those represent the range of returns that are available in Canada. You'll see that sort of gray line in the middle, and there's a gray area and a solid line. That's the median, or think of it as the average median return. And I'm looking at the left-hand side, and the blue square, that's the portfolio, and the red circle, that's the index itself. So over this 10-year period, what this is telling you is that the portfolio has delivered returns that are much higher than the red dot, which is the index, much higher, but also in the top 25% of all institutional funds in Canada. Then you move over to the next slide, the second from the left, and I apologize, the font is a little bit small, but it's standard deviation or the risk, and that's what we were using before. That's the volatility. So it's showing that the blue square is near the bottom 25% and much lower than the red dot, which is the index. So in review, you've got a portfolio that's delivering much better returns, but with considerably less risk. And then you move across to the next one. That's the third box from the left, and that's what we call the upside capture, in terms of how does the portfolio behave when the markets are rising, when they're rising. Well, what it'll show you is that we tend to lag a little bit. And that makes some sense. If we're not investing in all the junior gold companies and junior oil companies and the hot tech stocks, and when the market takes off, we might lag a little bit. And we tend to do better over a longer term, as is showed on that one slide, that one box on the left-hand side. But when the market's rising and rising strongly, we tend to lag a little bit. But and then finally, if you look at the right-hand box, the one on the right-hand side, this is what we call the down market experience. So it's better to have a lower number on this. And so what this is saying is, when the markets fall, when the returns of the index are negative, we tend to fall considerably less than most other portfolios, as represented by that gray rectangle, and much less than the index, as represented by the red dot. So very conservative, high quality portfolio returns, but with considerably less risk than the market itself. Now, one of the things I wanted to show you is the growth of assets over time, and the what this shows is, I use the example of $10 million. So, for example, suppose your municipality were to sell your public utility. It's a very, very common thing, selling it to Hydro One. It's happened to a lot of municipalities. And your PUC would have paid you a dividend on an annual basis. You sell it, now you've got the cash, but now you're not getting the dividend from the utilities that you once had forever and ever. Well, um, let's first of all look at how, if you would invest in equities, you're not going to invest just in equities, but let's say for this example, let's say you put $10 million in the one portfolio. This is live data. And I believe we're ignoring fees on this example here, but start with $10 million. And you can see, if you look at the left-hand side, a little bit of volatility. Oh, and there's a period there, 2009. You actually have less money than you started out, but you give it time and it grows and grows and grows. And at the end of the period here, it's more than 15 years, you would have about $35 million in your portfolio. And you compare that to investing in bonds, when the blue line, that's the FTSE Universe Bond Index, or the grayish dashed line, the World Index. Considerably better asset values at the end of that period. Next slide, Stephen. So let's also think about, okay, well, Brian, we're not just going to be investing this and going away. As you mentioned, we were getting in the example I had of selling the public utility, we were getting a dividend, and we needed that for our budget. So this doesn't necessarily help me if it just sits there. So in this example, we said, okay, $10 million invested in the equities. Let's take out of this portfolio on an annual basis, let's take out 400,000. So roughly at the starting value, it's roughly 4% of the value. And we're going to increase that 400,000 by a steady 2% every year. Every year, we're going to take a 400,000 plus 2% in subsequent years, and so forth. Now, the one in this example, when we did the calculations, we started it off 4 years down the road, and I think that's pretty realistic. People sell their PUC, and they get this money, and there's a lot of public debate about what they're going to spend the money on. That and looking at the longer term in terms of value added, we thought, okay, let's use an example. You invest $10 million at the start of the program, and at the end of year 4, you start taking out $400,000, and that increases by the 2%. And what would the asset values have been? Well, the $10 million would have grown to just around 25, as you can show on this slide here. So it does fit into the budgets of municipalities, but you have to take a longer term view on this. I'm going to finish off on this final slide, looking at the portfolio as it was at the end of September, and you can see the various sectors in the market, and how we've invested in individual securities. Now, some of these names may be more familiar to you than others, but it is quite diversified. You'll see, for example, on the right-hand side, we own a number of banks. The Royal Bank is shown there, Sun Life, the TMX Group, which I mentioned earlier, and other names that they're not as familiar to. CGI, you've probably never heard of that company. Well, that's a consulting group based out of Montreal. They service companies globally, not just in Canada, but they have customers around the world, and they're helping people to imagine an organization where they need to upgrade their software, upgrade their the software to manage their business. We're not just talking about websites and emails, but the structure of the information systems within the company itself. That's where they help, and you can imagine it's a very strong and growing business. Other names that you might be more familiar with on the left-hand side under the consumer staples, Loblaws, Maple Leaf Foods. So I'm sure that everybody on the call has probably used some of their products or shopped in one of their stores, or looking at a Metro, for example. I use that example, a grocery store. Now they've come under the microscope lately, but again, these companies are growing and they're quite profitable, and we think it meets the quality criteria. I'm going to end my comments there, And we can open it up for questions. And we're going to have Keith Taylor, Chief Investment Officer at One, to manage that part of the meeting.
Thank you very much, Brian. That was very insightful. I'm actually quite glad you brought up the legacy investment bit, because we do have a number of clients, municipal clients, that have done exactly that: sell down their local distribution company and take the funds and then invest it, and the income comes back into the operating budget. So it's we have a number of clients that are doing that, and more will come. It's certainly one of the avenues that municipalities are looking to fund their budget. Well, we'll have some question and answer. If you have any, if there's any questions from the audience, just feel free to pop them into the Q&A tab, and I'll get to them. But first, I want to just touch base on ESG. Is always a bit of an issue, or something that the clients are focusing on, and it's become much more of a focus, especially over the last 5 years or so. I know Guardian Capital has, as you mentioned, become a signatory to the UN Principles of Responsible Investment. But I just wanted to touch, Brian, on your thoughts about how the bias that the targeted risk portfolio has away from the commodity sector plays into this theme. Do you have any thoughts you can share with us?
Sure. And when we started this back in 2007-8 period, we weren't necessarily thinking of ESG. We were thinking of from the stats I was showing you earlier about what is the return expectation, what is the risk expectation, and we knew that energy and materials were as I mentioned, more volatile and less productive area of the marketplace. But as the market has, and we've seen a lot of changes over the last 15 years, and the market is now more and more concerned about the environment. That's the E of ESG, and it's quite nice that the portfolio fits in quite nicely with that, because when you look at the greenhouse gas emissions, we measure this on a regular basis. We have a dedicated professional that oversees. We have an ESG group that oversees portfolios, and we score very, very well on ESG measures in the portfolio. So it allows us to, and municipalities to say that you're invested in a portfolio that has considerably low, by a long way, considerably lower emissions than the index or virtually all of our competitors. We have the stats on that. We're quite comfortable with that. And that, of course, with the ESG, there's other things we look at. We look at, as I mentioned, the S and the G, the social, and then the governance part. So we're quite comfortable with what is held in the portfolio. I hope that answers your question, Keith.
Yeah, that's great. I think it's worthwhile broadcasting, because when I have an opportunity to present to council, it's a common question that comes up. You invest in oil companies. Yeah, but the exposure is obviously much less than the benchmark, and I know the Guardian does a good job of stewardship, so they are actually talking to the issuers and ensuring right. These issues are in the forefront. Next question. Risk for equity investors. Obviously, this is a targeted risk portfolio, and it's lower risk than you get in the general TSX index. But equities tend to be more volatile than bonds. What are your thoughts about the investment horizon that's necessary to really for an equity investor? I mean, the idea being that the excitement in the market that happens from year to year and the volatility that goes in there may be might not be appropriate for our investors to load up on equities if they need to cash out next year. Is there an investment horizon where it starts to make sense to be deploying dollars into equities?
Right, that's a good question, Keith. And I'm thinking now, as I go through the presentation, I think, oh, I could have added this slide and that slide. And I have some data. If any municipalities are struggling with this question, we can provide it to Keith, and he can forward it along to you. But we've done a study that looks at monthly returns of the index, the Canadian index, going back to 1956. And we've looked at it up to the present day. And we've asked ourselves the question, well, if you were to invest in the stock market for 1 year, and then it doesn't matter whether it's 1 year ending, October 2022 until October of this year, or if it was back in 1974, October 74 to October 75. We've looked at all that data and tried to get a sense of how the markets will behave over the longer term. And what we found is that if you invest in the stock market for a 1 year period, 1 year, and you come back a year later, on average, you're going to have about 25% of the time, you're going to have less money after 1 year. So put your $10 million into the stock market, be it this portfolio or on your personal portfolio. You put it in today, you come back a year later, roughly speaking, you're going to 25% of the time, you're going to have less money after 1 year. But then you start looking at, well, what happens if I have a 4-year time horizon, and then the percentage of times where we've had a negative return drops. When you get out to 7 years, if you put your money in today and you come back 7 years later, in this study period back to 1956, we've never seen a period where you've had less money after 7 years. And you can think of some of the horrific drops we've had in the marketplace. Think of the drop during the tech bubble period, and there was a period in '87 where the market declined quite rapidly. If you were to invest at the peak, just at the worst time, and then come back 7 years later, we've never seen a situation where you've had less money, and you'd be better off than just putting your money in a GIC or a bank. And again, I can share this data with anyone that wants to see it, but it's quite instructive when you look at it. So this is what I was getting at earlier, is that with an equity portfolio, you have to take that longer term view, because things can happen in the short term that can really hurt the portfolio value. But give it time. It comes back, and it comes back, and the data supports that scenario.
Wonderful. Thank you, Brian. Okay, two questions. First one we have here is, when's the right time to enter? Have we missed the boat? Are we too late? Is now a good time? I don't know if this is a question about dollar cost averaging, or I'll let you feel the answer to that one.
Yeah, one of the famous investors of all time, a fellow by the name of John Templeton, it was kind of a smug answer, but when they asked that question of him, they said, you should invest the money in the stock market when you have the money, which it's kind of a ridiculous answer, and probably self-serving on his part. But I think what a lot of municipalities do, and others, is that they stage it in. And as Keith was mentioning, dollar cost averaging, where let's say you've got $10 million allocated to go into the stock market. Let's say you put in 2 million now, and then maybe 6 months or 3 months down the road, put another 2 million in, and you keep staging it in. Really what it comes down to is we're trying to predict the future. When you think about it, we're trying to predict the future, what is going to happen. And we know that we can be terribly, terribly wrong. And so how do we manage that? Because we have a lot of smart people that work for us, and we look at what's going on with the economy and looks what's going on with our holdings. And despite all of our efforts, we can be wrong. So the first measure, and then it goes back to risk control. You diversify yourself in things that will behave differently. You have good quality holdings that will thrive in weak markets. And then you look at, you structure the portfolio so you avoid areas that will systematically underperform. So the other part of it is that in the there's an old saying in the marketplace, is that when stocks are rising, we call that a bull market. The markets climb what we call a wall of worry. So everybody worries that, like today, for example, everybody's worried that we're going to go into recession, and there's a lot of signs that we are, and as Stephen said, we're probably in a recession now. All likelihood, the data is pointing that in Canada, maybe not so much in the U.S., but in Canada, it's pointing to that. What we don't know is how deep that recession might be, but the stock market has started to rise. Certainly if you look at the U.S. market, you can see a lot of evidence that people think, well, yeah, there might be a recession, but it's not going to be too bad. But then people come out of the woodwork and they start worrying about things. Well, what about the Ukraine war? What about inflation? Well, where is it's a wall of worry. So you have to separate yourself out from the noise and say, okay, I'm not investing for 3 months. I'm not investing for a year. I'm not even investing for 2 or 3 years. And if anybody's got a 2 or 3 year time horizon, they shouldn't be investing in stocks. But let's say you've got in your asset management at the municipality, you have to replace a bridge in 25 or 30 years, and you need to allocate some money for repairs. Well, equities make a lot of sense. That's just what pension funds do. They allocate for the longer term, and they just look at whether you're going to have a drop in the market now or not, as sort of a waves on the ocean. I think on balance, and this is a long way of answering the question, but I think on balance, you're going to be okay. Um, the recession that we appear to be going into now has been long anticipated, and I think it's been reflected in the markets. But again, we're trying to predict the future here. So if you were to put money into the market now, I would put in a portion and then stage it in. I might even say put in a quarter of your allocation now, and then let's have a look in June and see what the markets look like then, and then people put a little bit more in. There is some cause to be worried now. I'm not trying to minimize it, but we can be so very wrong. You could find that as soon as people get the all clear that there's not going to be a recession, interest rates have stopped going up, inflation has leveled off, the stock market will take off. And as soon as we get to that point, you don't want to be sitting on the sidelines. So again, trying to predict the future here, you want to stage it in slowly. I hope that's a long-winded answer to your question, but I hope that helps.
No, I mean, getting insight from an industry veteran, I'm sure is appreciated. I do want to say thank you very much, Brian and Stephen, for making this presentation. Brian, thank you for your service to One Investment and helping us promote and better understand the product. We've started in what's been about 15 years.
Yep.
Our investors, broadly speaking, have been well rewarded for having this product be available. And thank you for being our partner with that. Good luck in your retirement. And thank you for your wisdom.
Thank you, Keith.
With that, we will conclude the webinar for today. This will be available after the fact. And if there's any questions or follow-up as appropriate, feel free to reach out to any of us at One Investment, and we'll get you the answers you need. Thank you again for attending.